Welcome to The Explainer. Today, we're breaking down a massive market rally and asking a really simple question. What was actually driving the numbers?
So on April 8th, 2026, markets just went vertical. They absolutely exploded. The trigger? News of a ceasefire between the US and Iran. But when you look at these gains, you gotta ask yourself, was this really just a simple sigh of relief, or was there something else going on under the hood?
Okay, so let's dive right in. We're going to peel back the layers here to really understand the mechanical forces, the hidden economic tensions, and the strategic game that truly drove this incredible move in the market. First up, let's talk about the catalyst. This was the big news that just sparked absolute euphoria across trading desks all over the world. So the headline was a huge de-escalation of what a lot of people thought was a brewing conflict. The risk of war just seemed to evaporate overnight, and the market's reaction was, well, immediate, it was overwhelming, and it was decisively positive. And look, this wasn't just a few big tech stocks doing all the heavy lifting. No way. This was a broad-based explosion of risk appetite. Money was just flooding into every corner of the market, especially those really economically sensitive areas like small caps and industrials. This was the textbook definition of a risk-on day.
But here's the thing. The sheer size of this rally, the pure vertical force of it, that wasn't just about good news. There was another powerful, mechanical force at play, working just beneath the surface.
And the key to understanding just how big this surge was is a concept called a short squeeze. Now, in simple terms, imagine you bet that the market's going to go down. But then, suddenly, it rips higher. You're forced to buy back in to limit your losses, and all that forced buying just pushes prices even higher. It's a vicious cycle.
In this slide, it really breaks down that chain reaction perfectly. You had huge institutional bets that war was coming. The ceasefire, that was the surprise plot twist. And that surprise forced all of those bearish bets to be unwound at the same time, creating this tidal wave of buying that just amplified the initial good news.
And to be clear, this was not a minor event. To put it into perspective, major trading desks like the one at Goldman Sachs flagged this as a truly historic level of short covering. We are talking about a move that was on par with the frantic rebound from the absolute bottom of the pandemic crash.
But here's the catch. This rally, fueled by a technical squeeze, well, it was built on a really shaky foundation. So let's look at the precarious economic reality that was hiding underneath all this euphoria.
You see, the market was cheering a strong jobs report, but at the same time, the ISM services data, which measures huge parts of the economy like retail and hospitality, showed employment was actually in deep contraction. And even worse, used car prices, a key driver of inflation, were soaring again. It's a classic economic tug-of-war.
And that brings us to this powerful metaphor from the source report. This is what's known as structural inflation, the kind that isn't temporary, but is baked into the system from things like damaged supply chains. So the rally is built on something that looks great, but it could easily be washed away by the next tide of bad data.
Okay, now in a normal risk-on rally like this one, where stocks are soaring, the playbook is really simple. Investors sell their safe, defensive assets to buy more stocks, right?
But that's not what happened. On the very same day, traditional safe havens like gold and silver also soared, with silver up an incredible 7%. Now, normally, this chart and the last one, they should be mirror images of each other. The fact that they weren't, well, it signals a profound breakdown in typical market behavior.
So, what does it mean when everything goes up at once? It suggests that while the trading algorithms were celebrating the short-term news, serious institutional money was actually hedging its bets. They were participating in the rally while at the same time buying insurance against long-term inflation and the risk of currency devaluation. And this fundamental conflict in the data, this tug-of-war, it's led to a major split among the top minds on Wall Street. There is absolutely no consensus right now.
And this just brilliantly illustrates that profound uncertainty. You have Morgan Stanley's models likely overweighting a new growth cycle. But then you have UBS flagging that their supply chain models are flashing red, warning of an inflationary trap that the market is ignoring. It is a fundamental disagreement about whether growth or inflation will win out.
So, what does this all mean for the path forward? Well, with the experts so divided, the report lays out two very clear, very divergent scenarios for what could happen next.
All right, so the bullish path, the one where this rally has legs, it depends entirely on inflation signals cooling off. That means WTI crude oil needs to stay calm, and the 10-year Treasury yield, a key barometer for borrowing costs, needs to fall.
If that happens, the strategy is to bet on big banks and big tech.
But the bear case, that's where this fragile piece just shatters. If Iran makes a move or oil spikes back above $115, that inflation sandcastle gets washed away. In that scenario, the playbook is to take your profits from this rally and run for cover in defensive assets like energy and gold.
The report also warns of a major black swan risk that the market is completely ignoring. On one hand, you have a massive multi-trillion-dollar investment cycle pouring into AI data centers, which consume staggering amounts of electricity. On the other, you have a global energy grid that's already strained. The market is pricing in the AI boom, but it's ignoring the potential for a catastrophic energy bottleneck.
So what's the final verdict? Well, short term, the outlook is cautiously bullish, mainly because the mechanical force of that short squeeze could carry things higher. But midterm, the view is neutral, because the shaky fundamentals and inflation risks are just too big to ignore.
And that brings us to the most crucial test of all, the upcoming Consumer Price Index, or CPI report. That's the government's official measure of inflation. And this data will reflect the economy before the ceasefire news. A hot number here could completely shatter the market's newfound optimism overnight.
And this leaves us with a final provocative thought. Hope, amplified by a short squeeze, can fuel an incredible rally. But reality, the physical reality of supply chains and inflation, will always have the final say.